Hello everyone, and welcome back to our next lesson, which is dealing ranges, but more specifically, multi-time frame operation. So we've laid the framework with IPTA and how to find our IPTA look-back targets, when we can expect those to be delivered to. Now the next piece of the puzzle is identifying dealing ranges and understanding how to operate within multiple different time frames. So to really understand what the algorithm is doing, what the algorithm is operating in terms of a range, we're going to be focusing on the 1 hour time frame and higher. So as you can see here, the 1 hour, the 4 hour, the daily, the weekly, and the monthly. Those are the time frames we're going to be spending most of our time on when looking for dealing ranges and understanding where we are in the range, what we can expect to be delivered to in the range, what we shouldn't expect to be delivered to in the range, so on and so forth. So these are the time frames that we're going to utilize when identifying our dealing ranges. So obviously, if we're looking at multiple different time frames, then we're going to be looking at multiple dealing ranges, okay? So the algorithm is always in a cycle, filtering from higher time frame to lower time frame, back to higher time frame, back to lower time frame, trying to understand what objectives need to be completed. So this is why we need to be aware of our monthly dealing ranges all the way down to our hourly dealing ranges. And the problem that most people have with multiple dealing ranges is, okay, which time frame do I use? How do I know? Let's say we're bullish. How do I know if price is going to return to discount of an hourly range, or if it's going to return to a discount of the 4 hour or daily range? That is the main focus in this lesson. We're going to look at how we can understand which dealing ranges we should expect price to deliver to in terms of discount if we stick with the bullish idea, and which dealing ranges we don't expect a return to a discount. And once we start to understand this, it is a really, really powerful tool with daily bias, institutional order flow, everything we discussed in IPTA, and it really starts to bring a framework together on where price is going. Now, in terms of the steps we take to identify our dealing ranges, we're going to use a top-down approach. And you can see here, I have number one as the weekly range. Then we look for the daily range in the 4 hour and the 1 hour, leaving out the monthly. The reason for this is that we simply just won't be utilizing monthly dealing ranges or monthly PD arrays as often as these time frames that you see right here. So if we do see a monthly dealing range and it's beneficial to us in our bias, of course we'll use it. But more often, we're going to be using these 4 time frames to locate our dealing ranges. So step 2 is to locate our key reference points in a premium and a discount of each dealing range. So we start with the weekly and we say, okay, these are our key reference points in a premium of our weekly dealing range and our key reference points in a discount of our weekly dealing range. Then we go to the daily dealing range and of course all the way down to the 1 hour dealing ranges, just to start to build a framework and understand what price could deliver to. Now, I won't spend too much time on this because you guys already have all this information in your key reference point guide, but we'll just be looking for things like fair value gap, highs, lows, quadrants, volume imbalances, high, low, CE, order block, open, low, mean threshold, breaker, open, low, mean threshold, wick quadrants, and of course everything else in that key reference point guide. But these are the levels that we want to identify inside of our dealing ranges. So after we've identified our dealing ranges on each time frame and the key reference points that reside in a premium and a discount of those dealing ranges, we need an invalidation level to say, okay, if this gets broken, I am wrong. I need to reassess my analysis. And we will have ways to refine this as we go along. But the main rule of thumb is as you see here. If we are bearish, the dealing range high is the invalidation level. If we are bullish, the dealing range low is our invalidation level. Because think, to form a dealing range, to identify a dealing range on either side of that range, there's a liquidity sweep. So let's say we're bearish. Why would our dealing range high be our invalidation level? Plain and simple. We've already had a liquidity sweep up there. So if we're expecting lower prices, we don't want to see price go back up there again because stop losses at the dealing range high have already been purged, and vice versa for dealing range lows. If price comes down to sweep sell side liquidity and we form a swing low, which would be, of course, our dealing range low, that would be our invalidation level. Because as long as our bullish analysis is correct, there should be no reason for the algorithm to go back down there to our dealing range low since it's already swept sell side liquidity. Now, what you see here is going to be the foundation for understanding which dealing ranges we can expect price to deliver to. So when we were identifying our dealing ranges, we used a top-down approach, right? We went from the weekly to the daily to the 4-hour to the 1 hour. When understanding how to operate with multiple dealing ranges, we need to use a bottom-up approach. So as you can see here with this yes/no statement, the main question we want to ask ourselves is the lower time frame dealing range discount supporting price? Let's say we're bullish here. Is that lower time frame dealing range discount key reference points supporting price? So the lower time frame, remember, we only go down to an hourly time frame. Is that hourly dealing range supporting price? If no, we're going to assume that we're going to return to a discount of the higher time frame dealing range. In other words, if we start to see signatures, which we'll discuss, of the hourly discount key reference points failing to support price, we're going to assume that the algorithm needs to reach down to a discount of the 4-hour dealing range. In other words, price would be weak. Price would be weaker than we thought it was. On the other hand, if the hourly dealing range discount key reference points are showing signatures that it is supporting price, then we're going to assume that we won't return to a discount of the higher time frame dealing range discount. So again, that would be if the hourly discount key reference points support price, we're assuming that we're not returning to a discount of the 4-hour dealing range, the daily dealing range, the weekly dealing range, and that all those PD arrays in those higher time frame dealing ranges should be breakaway gaps. And using that logic, we would be internalizing that price and the market is strong and we should expect higher prices and that our analysis is correct. So as long as the lower time frame dealing range is supporting price when we are bullish, expect the higher time frame dealing ranges to not be delivered to. So I won't spend too much time on this now because we're just flipping the previously discussed scenario for when we are bearish. But of course, we're using the same logic. So if we have our hourly dealing range, are the key reference points in a premium of that hourly dealing range rejecting price or acting as resistance, pushing price lower? If no, then we're going to assume that we're going to return to a premium of the higher time frame or 4-hour dealing range. That would mean that we are stronger than we thought we were, and we have to zoom out to those higher time frame dealing ranges. If those key reference points in a premium of the 1-hour dealing range do in fact act as resistance and push price down like we want to see because we are bearish, then we're going to assume that we're not going to return to a premium of the higher time frame dealing ranges, and that any PD arrays that have not been delivered to in those higher time frame premium dealing ranges should be breakaway gaps. And that's what we would want to see best case scenario if we were bearish, because that would mean that we're heavy, price is weak, we should expect lower prices. So now let's get into some chart examples. As you can see here, we're looking at ES's weekly dealing range. So we have this dealing range low and this dealing range high from when we were in sell side delivery here, okay? But obviously we can see price was very, very strong and attacked this dealing range high. Now this whole move up, was there a swing high that formed on the weekly chart to identify a dealing range from this low to that hypothetical high? No. Was there any retracement and return to what would be a discount just looking at the weekly time frame before we got to this dealing range high, this buy side target? No. Does that mean we can't trade and can't find ways to trade? Of course not. So let's look further. So going down to the daily chart now on ES, we see more of the same. Looking at this chart, targeting this buy side liquidity, was there any return to a discount while we moved up and got that buy side? No. Price was super strong and there was no retracement. Again, does that mean that we can't trade any of this move? No, it just means we continue to go down to the 4-hour and the 1-hour, identify our dealing ranges, and see what is occurring down within those dealing ranges. So before we get down to the 4-hour and the 1-hour to look at what was occurring, we can see here that we did in fact create a swing low and this swing high. Before this continuation to the upside here, when this swing high was formed, why didn't we return to a discount here? If we were waiting for this return to discount, we would have missed the move if we were only looking at the daily chart. So we need to, like previously mentioned, go down to the 4-hour and 1-hour charts and see, again, if we start to combine some concepts from our previous lesson, how we got to the 40-day IPTA look-back target, how we got to the 60-day IPTA look-back target, and then extended through to this buy-side liquidity. And now we are on the 4-hour chart. So first off, from the previous lesson on IPTA, this was our daily market structure shift, which set the tone for us to expect buy-side delivery. So with IPTA, it allows us to set our bias. What direction is institutional order flow operating in? Where can we expect the draw on liquidity? Those are the 20, 40, and 60 IPTA look-back targets. As we can see here, after identifying our bias, we need to look for ways that we can get involved. And that's where dealing ranges come in. But still, we're looking at the 4-hour chart and price is extremely strong. So we have CPI release here, right? Which sends us bananas to the upside. And then we consolidate and we deliver to this 40-day IPTA look-back target. But just like the weekly and the daily charts, why didn't we return to a discount of this dealing range? Why didn't we return to this large fair value gap here? We just need to continue to go investigate and see what is occurring on the 1-hour chart. So if we're looking at this hourly chart, we have our sell side swept, we have our buy side swept. So we have our dealing range low and our dealing range high. Now, in the upper right-hand corner here, that is our if-then, yes-no statement that we look for when looking at these dealing ranges on multiple time frames. So originally, after identifying this hourly dealing range, our invalidation level is the dealing range low. Our key reference points in a discount of this dealing range are this fair value gap right at equilibrium, this order block's opening price, and mean threshold of this order block. So as long as those discount key reference points support price and we don't purge this dealing range low, what did we discuss earlier looking at this yes-no statement? As long as the lower time frame dealing range discount key reference points support price, we're assuming that we won't return to a discount of the higher time frame dealing ranges. So is this supporting price? Yes. Now it's easy to say that hindsight, but that's where the signatures come in. That's where we look for those algorithmic signatures, what the bodies are telling us to understand if price is truly respecting these discount key reference points. So what signatures do we see here? Price is coming back down to a discount and it's wicking in to the tick, precisely, exactly, mean threshold of this order block. So the wicks are doing the damage, but we're aware that we're just delivering down to this hourly key reference point. On top of that, we've already had a stop rate down here. Sell side is already swept. That's why our dealing range low is our invalidation level. So as long as these hourly discount key reference points offer support for the algorithm, we're going to expect the 4-hour, the daily, the weekly, the monthly dealing ranges not to be returned to. After we wick into mean threshold of this order block, what are the bodies telling us? Is it respecting this fair value gap? Yes. So the wick's doing the damage into a key reference point, but the bodies are telling us time and time again that it is respecting this discount level, the discount of this hourly dealing range. So as long as that remains true, It is telling us that the market is strong because it doesn't even want to return to a discount of the 4-hour or the daily dealing range. All it's doing is working within this hourly dealing ranges. And those algorithmic signatures within the dealing ranges tell us if the market is strong or weak. And of course, we can see that eventually we do beautifully expand higher and get that 40-day IPTA look back target. So everything we discussed here with this dealing range, we're not just buying and hoping that it continues to go up. We have logical targets that we discussed in our previous lesson on IPTA. So once you combine dealing ranges with IPTA, it's really, really powerful in terms of a combination to understand where price is heading on these higher time frames. So of course, we expand and get that 40-day IPTA look back target, but we still haven't met our 60-day IPTA look back target. So whenever we have expansion, we're going to have new dealing ranges to work with, especially on the hourly and 4-hour time frames. So we want to make sure we're still identifying those dealing ranges on the hourly and 4-hour time frames. So we can see kind of that they're more dynamic ranges as we continue to move higher to our IPTA look back targets. Now remember, our invalidation level is our dealing range low. If we think on the opposite end of that, if we're bullish and our invalidation levels are not hit, we expect the dealing range high to fail. In other words, this can be a target. When we're bullish, we want to target dealing range highs as partials until we meet our major buy side objective, which is of course our 60-day IPTA look back target. So after we create this new 4-hour range, we just repeat the same process as we did before. From this low to this high, where's equilibrium? It's right here. What key reference points are we working within this discount? Well, first and foremost, we can see right here on my cursor, we dug in beautifully to mean threshold of this bullish order block, expanded higher, created the swing high, and we're working. Look at the wicks here. We're wicking below it, but look at the bodies closing above equilibrium of this dealing range. Those are the signatures that you look for. On top of that, where are we wicking down into? 50% of this 4-hour wick. After this, immediate rebalance here. And this immediate rebalance can be for you to study. So look from, let's say, December 16th to December 23rd, and you'll see this price action on the 4-hour chart and investigate this immediate rebalance here and see what occurred after we delivered to this wick high exactly, I may add, on the lower time frames. And guys, we just continue this process over and over and over again. So we're still on the 4-hour dealing range high. And this buy side being swept here with this high, that's what we just covered on the previous slide. Okay, so all we're doing is refining our dealing range high because we still haven't met our 60-day look back target. All right, same process. After we have this swing high formed, we just identify equilibrium of the range and our discount key reference points. So we have this fair value gap here. You would look at the quadrants. You have this order block here. You would look at the open. What else? Mean threshold and the low. What is occurring? We're working this order block over and over again. This right here is your algorithmic signature. We wick below, but look at the bodies. Close and open right at mean threshold of this bullish order block. These are the signatures you want to see until you meet your buy side objectives, which of course is our 60-day IPTA look back target. So I hope you guys can start to see we're just repeating this process over and over and over again with real logic. And to reiterate, as long as this 4-hour dealing range supports price, we're assuming that we're not returning lower to our daily dealing range or our weekly dealing range discount levels. And we can really start to gauge true strength in the market by just understanding dealing ranges and algorithmic signatures. So zooming back out to the daily chart, after everything we just discussed on our way up to get this 60-day look back, do we just automatically reverse and look for lower prices? No, we still continue to operate within those lower time frame dealing ranges. As long as those lower time frame dealing ranges continue to support price, we should expect that we're going to continue higher through this 60-day look back buy side target. If we're going to assume that we're going to continue higher, where would we target? Buy side liquidity here. And to bring it all together, We get that 60-day look back target. So this is our refined dealing range high. We're obviously in consolidation here, but are we seeing respect of a discount of this dealing range? Yes. We just continue to work this order block over and over and over again. So as long as that occurs, we continue to expect higher prices and eventually, of course, reach that daily buy-side liquidity. Okay, guys, so that's going to do it on our lesson on dealing ranges and how to operate within them with multiple time frames. Now, this next lesson, dropping next Friday at 3 p.m. Eastern Time, is on change in the state of delivery and macro signatures. Now, if you've watched the majority of the videos on this channel and are just familiar with how I read price action, this is going to be the most informative, most beneficial, and flat out best video that I've released on my channel yet. So I'm super excited to release this to everyone, and I will see you guys next Friday.